Good evening, everyone, and welcome to tonight's live stream. Sorry for the delay, a little technical difficulties getting online, and I'm really pleased to join you tonight, especially with tonight's topic. First thing I want to make sure is, could everyone just please let me know if you can hear the volume all right? That would be really kind of you. I'm live streaming across LinkedIn, YouTube, and Facebook. And so if you're on one of those channels, if you could just give me a thumbs up in the chat, or say yes, and I'll begin, and hopefully we have no problems with the audio. I'm really excited to be here with you tonight. Good evening. My name is David Aaron from Aaron Wealth Management. I do live streams every Wednesday at 7 o'clock, and we talk about all things financial planning, estate planning, investing, life insurance, personal finance, helping individuals and business owners. And yes, I'm an advisor. This was brought to my attention by a client, actually, and or not by a client, by someone who was asking me about a portfolio review, which I did, and they weren't sure whether or not I actually managed money. And I thought, wow, all the videos, did I forget to actually say I actually do the work, that I'm just not somebody on YouTube doing videos? So yes, I'm actually an advisor for more than 20 years now. I've been helping individuals and families and business owners. I manage money. I do life insurance. I do group plans. I do personal health plans. I don't trade stocks. So if anyone is thinking about, do I trade stocks? I don't trade stocks, but I use funds to help you grow your assets. And I use life insurance, obviously, to help you grow assets in a tax advantage way, but also to protect your estate. So I hope you're all doing well tonight. I'm just going to check to make sure the audio is on. If any of you guys, I get a thumbs up. Thanks very much. Okay, so I'm going to continue. So tonight we're going to be talking about, first of all, if you have any questions, you can put them in the chat. I want to hear from you, so please go ahead and put your information in the chat. We're going to be covering a few topics tonight. So we're going to just do a quick recap of the markets and talk about market volatility, why the market volatility is there, what's going on. And we're also going to talk about interest rates, what the Federal Reserve in Canada has done in terms of interest rates today, made an announcement, and what does that mean for you. We're going to talk about the Toronto housing market and housing in general. We're going to be talking about immigration in Canada and why that is or may or may not affect the housing market. And if you have questions, I'm going to answer those on the fly as well. So buckle up, stay tuned. We're going to dive right into this right now. Okay, so we're going to go to the first graphic here, and a lot of you are probably feeling like this right now, and that is obviously it's a bit tongue-in-cheek, but yeah, look at that. The markets run up, think like we're finally out of it, and then boom, we get hit with markets declining, and yeah, that is a problem. So why don't we just recap the markets year to date, and I'm going to break this up into sections, right? Year to date, and then I'm going to look at some of the history as well. So the S&P TSX, that's the acronym for the Toronto stock market, is negative 2.83% year to date. The Dow Jones in the United States is minus 5.62%. The S&P 500 is minus 8.6%, and the NASDAQ is minus 13.46. Now, this is what's gotten everybody really excited, right? And partially because the rates, the interest, or not the interest rates, but the rates of return for those indices are all negative. And we've enjoyed this run up in the markets. And so people are naturally nervous. And I'm going to explain a little bit as to why it is that way, so you can understand a little bit about, maybe it'll help you to lessen the anxiety around what your plans are for investing. I think it will. But let's just take a quick look here at something that I've done in another video, and that is market volatility. I want you to get used to the idea that we are always going to have market volatility, unlike what we had in the 90s and the 80s, largely because of something I'll talk about later on. But I want you to consider, when you're putting together your portfolios and you're putting together your ideas on, income for retirement, will I have enough money to retire? How do I safeguard my current investment portfolio? How do I safeguard what I'm going to be passing to my beneficiaries, my heirs, my children, charities, and that kind of thing? I want you to consider that we're always going to have market volatility, and we're always going to have these events that are really like bad for the day or bad for the week. So let's just review some of those, okay? Going back to 2001, 2002, this is the dot-com bubble bursting, and then followed by 9/11. These were, pretty, if I was to blow those up, they were pretty substantial declines in the market, minus 35%, and then followed by minus 20%. And then the market ran up from 2003 all the way to 2008. And then we had the worldwide economic financial crisis, minus 45%. Everything fell off a cliff. Not overnight, but it took about a month and it was done. And that had everybody scared. I think if you can remember that particular time, so many people were, I remember that time, I remember from August in 2008, people were freaking out. They thought their livelihood, all their savings was gone. Their home prices were going to, certainly in the United States, their home prices were falling. People were just leaving their keys behind and setting their houses on fire. Like they just saw their dreams evaporated overnight. And it was very devastating. Not so much in Canada. We didn't have the same problem, as you know, with real estate. But to see markets slide so dramatically, this is a lot of just one tip as to what I'm going to get into tonight as to why people are really unnerved by the markets in January, because we saw swings of negative 700 throughout most of the day and then ending plus 100. A swing like that in one day is very much reminiscent of what happened in 2008 and 9. And it's so close, you still remember what those days were like. So you start to think, is this happening all over again? Well, it's not. I can tell you that's not the case. But just to recap again, as you move forward, markets ran up from that time. 2011 U.S. credit rating downgrade, and that was a negative 18%. And it kind of just slid sideways, didn't it? From 2000 and we'll call it 12 to 2013 and a half, we'll say. The market just bounced up and down and went sideways. Nobody was really making any headway. And then the market shot up all the way from middle of 2013 all the way to 2000 and we'll call it 15, right? Because it went sideways again, 14 to 15, another year of nothing really happening, followed by a pretty good decline, minus 16%. This was the China GDP slows down. People were really messed. I mean, they were thinking, what's going on? China's slowing down. China, was growing at rates that people were thinking, how is this possible? And so slowing down, there was still double of the production anywhere else in the world at the time. And yet people were really upset about that. Greece defaulting on their debt. And then the markets, in a very choppy way, ran up from 2016 all the way to 2020. And then we had COVID, the coronavirus. And again, pretty much from March, a drop of 33%, and then an absolute, like it went down and then straight up again. So that is like a recap of about a decade. And what did you notice about that? Did you notice what I noticed? That these massive declining events are common all the way through that decade. It's not like, oh, this happens every once in a while. No, these are going to continue to happen. We're going to have these micro implosions, and you have to be prepared to manage your money around these micro implosions. But more importantly, what do you notice about the micro implosion? Just go back to these charts. In each of those cases, the market ran up, past the previous high, where we have the difference is 2011. 2011 didn't quite make it up as high as 2008, but it's certainly from 2008 to 2015, the markets went higher, but not that much higher. And that's the thing that I want to signal to you about this, that the markets do come back up, but sometimes they take a little bit of time to get to where your previous high was. All these gurus in the internet, and on TV, they all say, well, the markets always go higher than they were before. Yeah, they do. But for some people, and I'm going to show you a slide later, you don't have the time for that. You don't have 5 years to wait for the market to rebound to where your previous high was. And so I don't want I don't want you to be misled that they say, oh, you should always not worry about it because the market will come back. You may not have the time. It might be the most inconvenient time for your portfolio to drop. And this is one of the things we're going to talk about tonight. Okay, the Toronto stock market, the S&P. So if we look at this chart here, we see it run up, right, on the right-hand side. Well, let's look at the one-year return of the S&P TSX. So this is the Toronto stock market. You can see from February of last year, running all the way up close to 22,000 points, and now we're at 20,500, roughly there. And so you can see it has dropped down. But again, we're looking at this and we're saying, wait a minute, I've just lost 2.83% of my year to date. But the market has gone up so significantly over that period of time. So I want to just put it into full perspective that people, like, you should not be panicked about the market declining right now. It is not as severe and as big of a problem as you think. Here's the real problem, the NASDAQ. Here's the 2-year return on the NASDAQ. Now, I'm a big believer in technology. It's in every single one of my client portfolios, depending on the client's interest for growing their portfolio. And I believe that the technology is the way to go. It's going to, change our life. Over the next 20 years, technology is going to dramatically change our lives. So look at the way that the NASDAQ, which is tech heavy, ran up in just 2 years. It's a massive return. So what do you think you would do if you had massive returns and you were worried about, is this actually sustainable? Well, maybe you might take some profit off the top. Maybe you might sell some of your investment, take some of those gains and put it somewhere else, because you know what? We've had some really massive gains in the NASDAQ. And the NASDAQ was the biggest sell-off, right? When I go back to this slide again, the NASDAQ is minus 13.46%. Now, today with the Federal Reserve announcement, the markets were actually like soaring, right? They were doing really well until Powell got to the microphone and decided to really just do everybody in. But it was information that we kind of knew that was coming. And I'm going to talk to that in a minute. But here's what I want you to just put this picture in your mind. The markets are not behaving the way they did 2 decades ago. And there's a real good reason for that. 3 decades ago, I'm reminded of my aunt, may she rest in peace. My aunt told me stories when she was a young girl. She used to get on the floor with white gloves and spread the newspapers out, and they would go through the paper and pick stocks. Okay, this is going back a long time. And they would wear white gloves because the ink would come off of the paper, and so they wanted to protect their hands from getting dirty. But that's how they would pick stocks. They would spread the newspapers out, and they would look at what the stocks were trading at yesterday to make their trade for the next day. And so you see, we're in a completely different world today. Markets are moving so rapidly that it isn't like this. And so what I want you to pay attention to is things happen fast, so fast. I'm going to get into why the market is actually so volatile in a minute. But what's different about the market today, when you're looking at how to do your portfolio, how to plan, how much money you're going to have in retirement, or whatever capital or expenditure you're going to have, or whatever goal that you have to consider that you're going to have market volatility. But the market volatility isn't the way it used to be, where all we had to think about is how are the world economies running, what are the political, geographical events going on, and that's kind of how markets ran. Because what happened, we'll call it 2 decades ago, was traders would look at the performance of a company and they would decide whether or not that was a valuable investment for their client to get invested into. So they were actually pulling it apart, doing their analysis, and deciding, is this the right kind of company to fit my client's needs? And that isn't the case anymore today. In fact, it only represents about 10% of all the trades in the market. And I'm going to share with you you're probably saying, what are you talking about? I'm going to share that for you in a second. What's happening now is this. The market is behaving like a cat chasing after a laser. You flash a light on the screen, you take a laser and you play with the cat, and you put that laser all over the room, and the cat will just run after that laser. Well, that's the way the market is. And the market is really chasing after what is the news of the moment, not the news of the day, but what is the news of the moment. That is particularly troubling for you, for the average investor, to try to manage your money. If you're doing it on your own, it's really difficult. So the market really loves certainty, and this trader does not look like he's having a good day. So let's look at what does uncertainty look like. Here's what the markets are dealing with today. Massive returns in all markets over the last 2 years, but certainly over the last 5 years, we've had some serious market gains. We've dealt with COVID-19, the Delta variant, the Omicron variant, and all those led to supply constraints, restrictions and shutdowns, high inflation. We're at 5% right now in Canada and also in the United States. Labor shortages, largely because of Omicron, because everybody is getting infected because the infection rate is much higher, but it just causes people to not feel so good. So they stay home, or they shouldn't be coming to work because they're infected. So their employers are really dealing with, how do we get things done? We don't have anybody to come into work. Border closures. So what I say by that is, there was a time where we weren't allowed to leave Canada, and it was very difficult to get on a plane, or even we weren't allowed to drive over the border. Interest rate increases. Both the Federal Reserve and Canada both said they are going to raise rates in 2022 as much as 1% or more. Now we're dealing with Ukraine and Russia. This is a political geo event where that happens from time to time, and it makes the markets go wild. And then what are we about to enter into? The absolute circus of what the U.S. presidential election is going to happen. Remember, the presidential election is not far away, and it's about a year and a half before where people start to actually say they're running for president. So we're going to have about a year and a half of a true presidential election cycle, even though it's always on. But bear in mind, when that happens, it is just food for the internet. It's food for the stock markets. What will happen if Trump runs? What will happen if Biden gets in? What if Biden doesn't get in and he steps down and Kamala Harris takes over? Like, there's so much speculation and clickbait that's going to happen, that's going to drive the markets crazy. And I want you to be prepared for this very intermittent kind of days where it gets wild, where the market drops suddenly and comes back up again. This is what I want you to pay attention to. So I want you to pay attention to, is this a true sell-off? Is this a true recession? Or is this just something else going on? I'm going to show you how that works. And, I had a client actually yesterday call me and said, this is crazy. I think I need to get out. And I said, just hold on. It's not what you think it is. And sure enough, the market was down 700 and up 100. And he called me at the end of the day and he said, what is going on? I don't understand this. So I talked for a few minutes about what was going on. And I'm going to share that with you actually right now as well. Okay, so it's called machine-led trading. This is largely what's going on. 80% of by the way, I just want to check to see if there are any questions. If you have any questions, guys, I know there's some of you watching, so I'm happy to answer your questions. And if you like what I'm saying so far, please, wherever you are, whatever, if you're on YouTube, if you're on Facebook or LinkedIn, please like and follow and share the information, okay? The algorithm likes to push out that kind of stuff. Okay, machine-led trading. 80% of the daily moves in the US stock market are machine-led. What does this mean? There are algorithms that scour the internet for keywords. So they're looking for a negative or a positive keyword or a key phrase. And so if there's a negative phrase or a negative keyword around economy, political, about a company, it's going to trigger a sell order for that automatically. If it's a positive sounding or a positive sounding phrase or keyword for a company, whatever that algorithm is set up for that particular stock, it's going to sell, it's going to buy, it's going to trigger a buy order. This is happening automatically, 80% of that. So only about 10% of the trades are done by discretionary traders. Who are discretionary traders? Your broker, right? You go to a brokerage firm. I don't trade stocks, but I do trade funds, so I can buy and sell. And we make up 10% of the daily volume of trades. So it's really not you and me trading that's causing these huge spikes. It's actually computer driven algorithms that are making this happen. You cannot think for 1 second that the market was down 700 points and then ended up 100 points by just you and I deciding to get in and out of the market. It doesn't work like that. This is computer generated algorithms. So I want you to understand it's very difficult for you to manage money when you're up against these computers who it's designed to process millions of trades. It's craziness. Okay. So I want you to think about very clearly about what you're trying to achieve with your portfolio, what kind of investments you're putting in your portfolio, and try to understand that daily swings in your portfolio, try to ignore it and think about actual trends in companies. Are they making money? Do they have good market share? Are they, do they have good management? Are they actually making money? These things are still fundamentals, are really important to pay attention to because it helps you really just filter out the noise of the daily clickbait that these algorithms are searching for. So I want you to just try to not get too excited about what you see day over day. Okay. How do you like that? Did everybody, just before I move on, just as a curiosity, did anyone know this about how trades are done throughout the day? I just put it in the comments so I can get a sense of, were you aware of that's actually what's going on with trades? It's not really you and I affecting the markets. This is a new thing. This is really a very new thing for the stock market. And we're still coming to grips with this. I suspect that someday the government, especially in the US, they like to do all these investigations, are going to have something to say about these algorithms and the way that it makes these massive swings, because it is very detrimental to a lot of people. Okay, let's move on to immigration, I think. Okay, immigration, both Canada and the US. That's not right. This one. There we go. Immigration. Okay, Canada had a target for 400,000 new immigrants in 2001. Where did those immigrants come from? They came from people who were already here. So that's why it didn't affect the housing market, because they actually just changed their status in Canada. They went from non-permanent resident to permanent resident. And so it actually was just more of a status change than an address change. So the idea here is, there we go. The idea here is that, when you think about during COVID, and when they talked about there's not going to be any immigration, but yet we had an uptick of 400,000. And you think, well, how did that happen? That's because their status changed in Canada. And a lot of these people were actually students. Thanks, Ivan. Thanks for letting me know. A lot of the status change were students. So students changed their status from non-permanent resident to resident. And what does that mean for us in terms of how that will affect the economy and a bunch of other things like real estate? Well, 400,000 people just had their status change that allow them to find work a whole lot easier. And they're graduating university and they're willing to work for less. And guess who wants to pay employees less money? A lot of employers. They're under a lot of strain right now, and they're having to negotiate on salary because a lot of people are choosing not to come to work because they're getting paid to stay at home. So all these immigrants who have changed their status are quite willing to work, and they're going to be able to really do something fundamentally different with the way real estate is going to happen. I think once you pay attention to this, you'll understand where I'm going with this. So why is this one thing important? By the way, Canada had 400,000. United States only had 500,000. United States typically has legal immigration of about 1 million people per year, but they only had 500,000 people. So they have a much more severe problem with labor shortages than we do in Canada. So why is this important to you to understand this? Well, because of real estate. Well, we know that there is a supply-demand problem with real estate in Canada. And the problem here is that we can't build homes fast enough. And people say, well, that's not really a problem, right? Because we're not having a lot of immigration during COVID. And it's not true the way in which Canada reports immigration. Yes, we didn't have a lot of people entering Canada for the first time, but they were already here, and 400,000 people now are eligible to be able to go to work, get bank loans, get mortgages, and buy homes. For now, they've only been renting for the time being, but now they're going to rent. Immigrants typically take about 5 to 6 years to be able to get into home ownership, but because they're young, they're educated, and they can work, that is going to change. They're going to get into home ownership a lot faster. So if you think that we had a problem with demand in Canada, it's going to get a whole lot worse. In fact, just share some of my notes here on that subject. The actual demand in Canada for new housing is actually much higher than CMHC and Statistics Canada reports. The demand is about 30,000 to 40,000 higher than current CMHC and Stats Canada report. So this is going to place an even greater demand on housing, and housing prices undoubtedly are going to continue to rise despite interest rates going up. What will happen when interest rates go up? That it's just going to be making home ownership more unaffordable for a lot of people. And the problem here is, with all these immigrants going to home ownership, and with 30 to 40,000 higher than what the government is saying, you can expect that housing is going to be a problem in Canada. So what does that mean for you? If you're in a home, don't sell it. Your price is going to go up from underneath you, that's for sure. Unless you're going to move somewhere, downsize, and go to maybe another province where housing is cheaper and lifestyle is cheaper. That's like going from here to PEI or here to New Brunswick, that kind of thing. When I say here, Ontario to New Brunswick. Some of you may have no choice because your home is part of your investment and retirement planning. So your plan was downsize and go and use some of that money to actually live in retirement. One of the reviews I did with the client early on Monday was, looking at planning scenarios about what to do with their home at retirement. Do they sell it? Do they keep it? And so the idea was they were going to sell it, but do they need to go and buy something? Would it be better for them to rent something? So that's one of the things that is sort of a discussion is, well, it's kind of a lateral move. The moment that we sell, we're just moving into an environment where it's quite pricey to buy something. So how much can we actually buy? And how much will that go up ahead of our current home? So those are really, I'm not a real estate agent, but I just want to share with you the analytics behind the problem that we're facing with real estate. Here is the Toronto housing market. Look at the graph, out of control, just skyrocketing. That is not going to change. The demand to live in the GTA, the Greater Toronto Area, is so high that they cannot keep up. They're actually having a problem with just infrastructure, subways, buses, streetcars, schools. All these things are a massive problem for the GTA. It's going to require a lot of spending to be able to bring everybody up to speed on that. Look at the actual, this is the housing. These are homes that are sold. This is the average selling price in the GTA. And you can see here the red, dark red, 1.4 million to 2.4 million. That sort of light red was 1.1 million to 1.2 million. So you can see that, the majority of homes here are selling for at least $1 million and higher in the GTA. That is a massive problem for anybody who is young trying to get into the real estate. And what do they have to do? They have to save like crazy, rent for a while, have parents help. It's a big, big problem. But if you can get into a home, it's likely that you're going to make money, and it might be your best asset. Now, I'm not a real estate agent. I don't sell houses, but I do tell my clients who are affluent that I tell them, you can give me money. I'm happy to manage your money, but I also think that you should buy real estate. It's going to be one of the easiest places to park your money and make money. And the hard part is getting a piece of real estate. In fact, I have clients that have made $200,000, $300,000 sitting in condos and they're renting them out, and the market just exploded underneath them in such a very short period of time. And that they didn't buy the condos for that particular reason. They bought the condo because they want to have rental income throughout their retirement, but now the properties have just gone through the roof. So here are some home sales in December 2021. Just to give you sort of like a breakdown of properties. So detached homes in Toronto were up 29%. The average selling price was 1.6 million. A semi-detached was up 26%. The average price almost 1.2 million. Townhomes up 30%, almost 1.2 million. A townhome, okay? A townhouse. And these are the new townhouses that are very narrow, 3 stories, narrow stairways, very small bedrooms. You can't have a king in one of these townhomes. It's going to be really uncomfortable for you. And they're selling for nearly 1.2 million. A condo apartment is up 18% at 712,000. This is massive, guys. This is why real estate has been such a big moneymaker for so many people. And also, if you couldn't get in, it's really difficult for you to get into a home. If anybody wants the website for this information on GTA housing market, this is for December 2021. I'm just showing the top 17 cities, the regions here. So you see King is up 44.8%. You see Rosedale up 45%, Uxbridge up 78%. This is a 1-year change. Crazy 1-year change. Stouffville up 62%. East Gwillimbury 53%. Like, those are people getting out of the city of Toronto and going up north and saying, you know what, we're going to buy something up north where the property value is lower. And then look at this, it goes up so dramatically. This is a significant amount of money that you can make in real estate. Remember, I manage money, I do life insurance, but I'm all for helping my clients find alternative investments to make money. So I'm not shy or greedy with my clients saying, no, don't take your money away from me. Look, my job is to help you grow your net worth. My job is to without bias, to grow your net worth. That's if I'm just simply saying, no, you shouldn't do that, then I think you need to examine your advisor's priorities or agenda. If they say they should, if somebody says, we want to take some money and put it into the real estate, and they tell you no, I think you ought to examine their priorities and really reevaluate your relationship with them. Okay, now, one of the things I want to share with you that I've shared in other videos, and this is the retirement income timeline. So when you think about markets crashing and markets with extreme volatility, if you're young and you don't have to worry about retirement for a long time, then markets correcting from time to time has it's irrelevant really for you. You have time on your hands. So the income timeline is really a 10-year window, the 5 years preceding retirement and the 5 years into retirement. This is that 10-year window. You really don't want to have massive declines in your portfolio during this time. One is the last 5 years before retirement is really your ability to just sink as much money you can into your retirement portfolio, pay down your debt, like be prepared and ready for retirement. And then first year of retirement, you start doing redemptions. You don't want to be doing redemptions in a negative environment because that's just going to create a bigger problem for you. So you want to make sure that your portfolio, if you're in that window right now where you're 5 years out, you really want to rethink how much equity you have in your portfolio. You should not be swinging for the fence, trying to hit home runs. You should really be measured in your approach. It goes back to what I always tell my clients about goal-based planning. You need to have, I always say, you need to have a financial plan, but you need to have a very specific goal in mind for your portfolio and that have timelines, when you're going to use your money, how much you need in any given period of year, and think about how to invest your money in the lowest possible risk profile to achieve that goal. So one of the things, for instance, when I did reviews with clients, I've been doing reviews all January, And that is I do, which I'm not going to put up today, the dashboard, the financial dashboard that all my clients get. But the financial dashboard, and I know if any of my clients are on right now and you love that dashboard, give me a thumbs up so everybody knows how great it is. But it tells people exactly where you are in like 60 seconds. Where am I hitting in the financial goals? Are these being met? Are we behind? Are we actually going to hit those goals? And so the financial dashboard says a couple of things. One is, what kind of rate of return do you actually need to hit the mark? So, right, the mark that you need to be able to have the income throughout retirement. So if you need to, let's say, I'll just throw a number, and I don't want you to think this is exactly what I think you should do. I'm not sure what that says, because I think it's in a different language, but thanks for commenting. You want to make sure that you grow your investment to a certain amount, certain balance, because that amount is going to produce a certain income for you throughout your retirement. So you have a target, right? So if your target says you need to get 4% rate of return because you already have enough money accumulated to hit that target, then do you need to get 12%? Do you need to, I know it's important to make money. It's not up to me. My job is to help you to see what number you actually need to achieve. And that's up to you to decide how much further above that line do you want to go. Because what you're really doing is you're shoving your money to this line. You're saying, I'm going to invest this money. And we have this market volatility that's going on. And we have every now and then we have these implosions that happen that sometimes takes 5 years to recover. How much of that do I want to push to the line? Do I really need to do that? And so you need to be measured in your approach about how to manage your money. So if you only need 4%, should you be trying to get 12%? So maybe you get 7%, 8%. Like really think about your risk tolerance. So I hope that you understand that. Okay, what do you do next? Well, I'm kind of talking a little bit about that, right? The first thing you want to do is have a portfolio review. So you talk to your advisor. If you don't have an advisor and you're just working somewhere and you don't have a relationship, ring me up. I'm happy to talk to you. Portfolio reviews always cost nothing when you talk to advisors. They're happy to do them for you. I typically will write my notes on the actual statements that you provide and hand them back to you so that you can take those notes to your advisor and say, look, I've been thinking about a few things. What do you think about this, this, and this? It'll start a conversation. It'll actually help you and your advisor. And I know it sounds like utopia here, but I just want to be clear about something. There's enough people in the world. I'm not greedy where I think I'm only going to give advice to somebody or give a suggestion to somebody if they come to work for me. I think if someone comes to me, picks up the phone and says, hey, I have a question, I think we should be in a position where we can answer that question without thinking, oh, no, you got to come over to help me. I'm happy if I can to give you some suggestions, but not full financial planning. Obviously, that's not what I do, but giving that out for free, that kind of work is for my clients. But when somebody says, can you do a portfolio review? I share that information with them. I actually write it down on their statement, and then they take it away and talk to their advisor. What it does is it helps shape the conversation so that they do better. And so what I've always found is when I tell people exactly the truth of what their position is, if something happens later on where that relationship falls apart, they'll remember that I gave them good advice and the truth. And so I just firmly believe in doing that. Examine your risk tolerance. I just talked about that. Do you really need to get 12% when your financial plan says you only need 4 or 5 or 6%? Portfolio reviews. Hi, Rosemary. I'm going to explain that to you. Rosemary is saying, what does a portfolio review mean? So I'm going to share with you exactly what that means, okay, in just a second. The next is your need for capital. So you do a portfolio review, look at your risk tolerance, and then say, how much money do we need to spend this year? I would say, think about the next 6 months and make sure you have that in cash. So you can completely take out this idea of market volatility, you trying to do withdrawals, when the markets are declining. And I'm not saying the markets are going to decline. I'm going to talk to you about that now, but I'm not saying markets are going to continue to decline, but you shouldn't do withdrawals when markets are declining because it affects your ability to grow your portfolio when it goes forward. So try to have what you need for the next 6 months, have it in cash so that you're fine and that you can allow the markets to get to where they need to go and to move forward. So let's talk about markets for a second. And my own, I've got a crystal ball on my desk, and here's what I think. I firmly believe that we're going to have volatility through the month of February. I don't see the markets doing an absolute reversal and then we just start going straight up. The market knows that we're going to have 3 to 5 interest rate hikes in Canada. We're going to have to resolve something with Ukraine and Russia because that's going to create tension. It's going to create uncertainty, and the market's going to bounce around because of it. It always does this. When there's a political geographical event, the markets always are volatile. So I suspect that through the month of February, you're going to see not days where you have negative 700 plus 100, but I just think it's going to be choppy. And then I believe that in March, we're going to have our first interest rate hike. It'll probably be 0.25%. Again, my crystal ball, right? But it's going to go slowly. We're not going to have all of a sudden 0.75% increase. It's going to be these little pieces of rates, maybe 0.25 point every time. And we'll likely have at least 1% increase by the end of the year. What is good about today's announcement is that the market, again, doesn't like uncertainty. And when historically, the Federal Reserve in Canada, they'll say things that people are trying to interpret. What does that mean? Does he mean that they're going to raise interest rates? What do they mean? Today, they came straight out and said, we will raise interest rates. We have to raise interest rates because we have to get inflation at 2%. This is what's going to happen. So you have to bear in mind the markets are going to need to find the right equilibrium to be able to say, what does the world look like for us in investing if interest rates are at this level? And it's going to take time for that. And it's also going to take time for us to come out of Omicron. So we're probably very close to peaking with Omicron. And that means that the supply constraints, the labor shortages is going to take time to fix itself. And so my feeling is that over the next, let's say, month, we're going to start to get back to a little bit of a normal, after February, we're going to get to sort of a better environment and things will begin to improve month over month. So my expectation is from March to the end of the year, we are going to have a really decent economy. Markets are going to be favorable to invest in. So for the next month, just, try to hold your breath, bite your lip, re-examine your portfolio so that you're not overexposed to anything that you shouldn't be. And you're going to be just fine. Resist the temptation that the news is selling you, saying the world is crashing around you, because that is not what's happening. No banks are forecasting a recession in 2022. No banks are forecasting a crash in 2022. They're actually the opposite. They're forecasting a good and favorable environment to invest in. So this is what I wanted to share with you, most importantly tonight, so you can just try to get away from this noise. And this is the way that they sell, right? They sell news this way to get you excited, to get you fear about what's going to happen. It's not going to happen. You just have to weather the storm for, I think, for another month, and then you'll be in the clear and everything will be fine. Okay. So again, the number one thing to do is make sure you have a financial plan that addresses your needs. I always say this in every single meeting. It's seeing the outcome of your planning decisions before you commit to them. It's so important to do that. I know the message is getting out because I'm getting phone calls every single day now of people asking me to do financial plans for them. Okay, back to your question. I'm going to answer the question that Rosemary put up here. What does a portfolio review mean? Okay. Thanks for your question, Rosemary. And it's actually a good question. A lot of people maybe have a misunderstanding of what it is. And I know a lot of people also feel very intimidated about getting a portfolio review by their own advisor. Because there's this dynamic a lot of times where people come into the office when you could go into the office, and you're kind of like, they know more than me. And so whatever they say, I got to believe. And and it's 20 years of me seeing that in what people think about that. And so I want you to examine this. So a portfolio review is very simple. You get your statement, your most recent statement. You have an advisor that you want, that you feel like, you know what, I believe this advisor is credible, that they have the experience to manage money. And I'm going to share with them this statement, email it to them. Okay. And what they do is they should know a little bit about you, right? Your age, when you plan to retire, your current risk tolerance. Because a lot of times when you first go in to start an account, like you go in to create an RSP, they'll give you a risk tolerance questionnaire. This risk tolerance questionnaire is somewhere between 14 to 18 questions, right? And it's like, what is your need for capital? What would you do if the markets declined by 5%? Would you sell? Would you stay and do nothing? Would you add to your portfolio? All these questions, right? When do you plan to retire? And so you do that. And then you never change it. And you get 10 years older and you never change your risk tolerance, but you're 10 years older and your risk tolerance has changed absolutely. And so what will happen, and especially as markets have run up the way it has, Rosemary, if people wanted like your allocation of your portfolio, so you think about how much equity you have and how much fixed income. Fixed income dropped during this period and equity shot up. And so if you had this a risk tolerance that said, I want 60% equity and 40% fixed income, it's likely that the equity position has gone way much higher as a percentage of your total holdings. And now you're not 60-40. Now you're maybe 80% equity and 20% fixed income. So all that is just rebalancing your portfolio so you go back down to 60-40 if that is your risk tolerance. So the first thing to do is you get a financial plan. You don't have to do a financial plan to do a portfolio review, but the first thing is have somebody review your investments to make sure that they're still in line with what the target was for the allocation. If it was 60-40, if for instance it was 60-40, if you're a conservative investor and it's reverse where you have 40% equity and 60% fixed income, again, that 40% equity did really, really well. And it's probably that you're imbalanced again. So that's how a portfolio review, that's the first thing that happens in a portfolio review, is that you can see whether or not your allocations are not in line with your own target risk profile. This next thing is, what is your risk profile? You, like I said, 10 years ago, 5 years ago, you started your RSP, your tax-free savings account, and you're not the same person you were 10 years ago. You're older, you might have kids, or maybe you're retired, maybe you're a widow. Like all these things have changed. Maybe you started a business. Like a lot of things change and you forget, oh, I need to change my risk tolerance, or maybe I should just answer those questions again. So it's really important that you answer another risk tolerance questionnaire to make sure that, wow, my risk tolerance is much lower than it was when I was 35. So maybe I should change my portfolio to adjust it so that I can sleep at night. So I don't have this anxiety when all of these things are happening. And you wonder, I can't take it anymore. Well, maybe it's possible that your risk tolerance has changed during that period of time. And all it would be a matter of changing your risk tolerance. You know, I have retired clients, and when I talk to them, they don't talk about their portfolio because they're so conservatively invested that what's happening today isn't really affecting them. And they're thinking about other things. They're not really thinking about their money, and their money really hasn't changed all that much in the sense of it going down. It's making money ahead of inflation, that's for sure. But these people are really sleeping well at night because their risk tolerance is in line with protect my asset, grow it ahead of inflation, grow it to make sure I still can have the income I need. So I need a little bit of equity. But like the main thing is protect my capital. This is what's really important. So that is how you do a portfolio review. It really is so easy. Email your statements to an advisor that you believe that you could talk to, and they're credible and they know how to manage money. Though I don't know if all advisors do this, but I write my notes on the actual statements and hand them back to you so you can take it to your advisor and ask them questions about, do you think we should change this? What do you think about that? And just make sure that your allocation is not out of whack because equities ran up, and then do another risk tolerance. Then the next thing you want to do that's kind of on the side of, well, it's attached to a portfolio review. The next thing you want to do is you want to make sure you have a financial plan. If you look at investments, and we're just about done, I'll just leave you with this idea. If you look at an investment in a bubble, like in a vacuum, okay, and you say, what do you think of the Canadian Dividend Fund? Like without any other outside parameters, just that fund alone, it's really difficult for you to say, well, is this a good fund? Well, okay, yeah, it made money. Here's the risk tolerance. I mean, by itself, it really doesn't mean anything until you put your goals beside it, right? That's when choosing a fund changes completely, or choosing an investment changes, because the moment you take an investment and put it beside a goal, you can almost instantly, and I do this with clients all the time, you can almost instantly see whether that is right for you or not. Like you can see right away, when just as an experiment, you can, if I was to push across the table a portfolio, an investment portfolio, and say, here's your investment portfolio, and it's like a really high risk, complete exposure to the markets the way they are, and that person is a very conservative person, you can actually see their body change, the way they breathe, they push back from the table, you see them, they'll do this, right? So you can, when you see an investment by itself in a vacuum, there's not much you can say other than here it is. But you put somebody's goal beside it, and that's the measure of whether or not that's a really good investment or a really bad investment for that person. So the next thing after a portfolio review is you do a financial plan so that you can match up your goals against your current portfolio. And that is really the value of a financial plan, because it's now taking a portfolio out of a vacuum and putting it beside your actual goals and say, is this the best thing for me to move forward with, or do I need to change it a little bit? And that's the value. And I'm so big on doing financial plans. It's so important to have that. It gives people, last review I did with a couple who he turned 65 in January. She's 67. I did a review with them, and he's like, and he's retired. And he's like, both of them were so relieved. We're just, you can actually see it on them, feeling the anxiety just melt away, that they knew without a doubt, without a question, they have enough money throughout retirement. They're not in any danger. They're actually doing awesome, and they can just go about planning their retirement. And that's what a financial plan does. That's what a portfolio review does. And it doesn't take much time. It takes a few hours to go through a statement and come up with, here are the recommendations, and you get it back to you. And then it's up to you what you do with it. Okay, enough of my soapbox. It's a great question. Thanks very much for that question, Rosemary. I hope that answered your question. And if there are no other questions, I'm going to call it a night, because you've been here watching this guy talk for about 54 minutes already. I was really thrilled to give you the insights that I have on what the markets are doing, inflation, real estate, how to manage your money during these volatile times. I can tell you right now that starting tomorrow, there's going to be a new video dropping every single day for the next 10 days. It's my RRSP series of on videos on registered retirement savings plans. Everything about registered retirement savings plans, including strategies, tips, what to avoid, what you should never do, all these wonderful things. And one is dropping every single day. So I hope you enjoy it. If you do, put some comments in. I'll be happy to follow up with you. Okay. Again, last thing, I always end my sessions by telling you that we take care of your wealth management so you can take care of what's most important to you. I firmly believe in this. This is the most important thing. This is why you work so darn hard, is to take care of your family, to take care of your goals, your dreams, your aspirations. This is about your future. And so it's important that you work with a credible advisor to map out your future so you can take time to just live your life and enjoy what you're doing with your family and friends. Here is my contact information. If you have any questions at all, this video is being live streamed across YouTube, Facebook, and LinkedIn. And the video will be up on YouTube permanently so that you can go ahead and watch it anytime. Just give me a few minutes to edit it properly, to put in some information. And if you have any questions, feel welcome to reach out to me via email or phone or any one of those mediums, and I'll be happy to talk to you. Again, thanks so much for taking the time to spend almost an hour with me this evening. I hope you're all well and safe. I look forward to seeing you next Wednesday at 7 o'clock, and I will endeavor to be on time for 7 o'clock. And again, thanks so much, and we'll see you in the next video. Take care. Thanks.